like a PowerPoint slideshow?
Yeah.
Excellent, brilliant. Okay, so this is the first Zoom meeting I've been on. I normally do these kind of workshops in schools and colleges. Been going around doing them over the last year and a bit. Age range wise, it's kind of like 12 plus, so some things may just kind of be like, yeah, I know all this already. Other stuff maybe over your head, depends on the age range of who's watching. But really, it's just a way of imparting some knowledge that I feel the younger generation don't get in an education environment at the minute. So I'm just going out there through my brand, my company, and just giving like a high level overview. It's not heavy, it's not in depth. It's just some things that you're going to be finding out or being susceptible to when you go out into the wider world of work and finance, basically. So we'll kind of make our way through it. I apologize if it gets a bit dry. Obviously I'm more kind of, it's an interaction based environment normally, so I can kind of feedback on what people are saying rather than me just chatting for 45 minutes, but I'll try and vary my voice to make it as interesting as I can. So a little bit about me. I don't tend to drone on about myself too much, it gets a bit boring. As Jen said, I've 10 years in financial services, few qualifications under my belt, which kind of means I'm qualified to talk about this kind of stuff. Been a previous area manager, got a degree in business, own a company doing mortgages and property investment, and we lend quite a bit of money per year to people. So I've just been out there in all areas, and it's just information I'd like to pass on to you guys. What we were going to look at was or is types of credit. Investment choices wise, I should kind of really put it in brackets really, because it depends on the vantage point, but different investment choices, how to budget, and then how to plan for the future, because a lot of people nowadays, especially the younger generation that I encounter in my job, they haven't really had any discussions around the future and what planning should be for them. So it's just something I've thrown in. And then the open session, as Jen said, will be, you know, kind of where people have got questions and they just want stuff to be covered off, okay? So, types of credit that you may or may not be aware of. There's short-term and long-term credit. So as you can see, I've put them in different colours so you can differentiate, but bank account is an obvious one. Bank account is the way people use money, they get paid, they spend, you get a debit card with it, and it's plastic money basically. You can only spend what you've got in there, and it's short term, it's not a savings account or any very an investment, it's purely, you know, your little piggy bank, if you will. Overdraft is short-term credit which is made available as part of a bank account. An overdraft is where a bank has said you can borrow a small amount of money should you need it, and then you pay it back. So for instance, I don't know, you've got £100 in your bank account, you've got an overdraft of £100, so you can spend 200, so it goes from positive to 0 to negative, and then you pay it back over a short period of time. A credit card is, I suppose, in essence a bank account, but you're not spending your money, you're spending the bank's or the credit card provider. That's a way of just using the card, buying items, and you borrow it over a short period of time and pay it back. Can be quite costly. Credit cards that can run up large bills. People just tend to just forget that you've got to pay it back and just go crazy and spend money on them, you know, without thinking of the repercussions. If you pay it back the month you borrow the money, it doesn't cost you any interest because interest is charged monthly, and it's a good way of building up your credit profile. So your credit score is what lenders will look at as you get older and assess your possibility of borrowing, and a credit card is a way to build that borrowing and paying it back. Personal loans are a type of credit which is available as a lump sum to you rather than spending bit by bit. the lender will give you a large lump sum, and then they divide that lump sum down over the amount of months that you want, and you make the payments back. So it might be £5,000, you pay back £100 a month for a set period of time. They always have a bit of interest added on, and if you pay it back early, you get the interest back because it's calculated over the term of time. Hire purchase is a loan that's attached to an item. So this is how most people purchase cars or motorbikes or, you know, vehicles as such, but nowadays they're moving into other things. Furniture is a big one. You can buy furniture on hire purchase, where, you know, you buy a sofa, you pay 0% for 12 months and pay it off. Long-term types of credit are essentially the same sorts of vehicles, but they're over a much longer period. So a mortgage, many of you would have heard of, is the way that most people in the UK will buy a property, and that's they take a large loan from a bank or a lender or a finance house to buy a house property, and then they'll pay it back over a set period of time. 30, 35 years is the norm nowadays to start off with. Pensions is a saving, but it is a type of credit because it's available to you in your later years. So it's a savings account that you build up over your working time frame, and then when you decide to retire, you'll take that as your income. So it tops up the state income that you may get. And investments, I'm talking about long-term investments. So if you're investing in like a capital growth plan, you know, the old Prudential type stuff where you put in money monthly and they link it to stock market and it rises up over a long time frame. They're not designed to be short-term investments. So short versus long-term, and when and why you would use it. Obviously, it depends how you use it as to if it's wrong or right. As we've seen there, some examples, you know, hire purchase, buying a car, mortgage, buying a house. Using them in the right way will prevent you paying any extra fees that you may not have to pay. Incorrect use, costly and wasteful. So a credit card, for instance, if you took a credit card out and you racked up a bill on it, it doesn't matter what the bill is. If you paid the minimum payment on a credit card, it would take you 21 years to clear the balance. And that's because what you're doing is you're paying off a small percentage of the balance, but they're putting interest on it. So you may be paying £10, but there may be £8 of interest. So you're only clearing £2, which is why it can take such a long time to pay it off. And you know, obviously short and long term is different. We've surmised that anyway. So investment choices, and wise is kind of, you know, what's wise and what's not. But I cover this off because it's a lot about supply and demand, depreciating and appreciating. So appreciating is an increase in the value of an asset over time. It can occur for a number of reasons: demand or weakening supply. So for instance, if fuel price fell through the floor, petrol cars may be more popular than diesel cars. So therefore the price would go up because the demand for them is higher. Similarly, if it went the other way, the price of cars would fall because no one would want them because fuel's expensive and they want to go over to diesel. Depreciation is a reduction of asset for the same reasons. If you're going to invest, you invest in an appreciating asset. So property is a common one. Property pretty much goes up unless there's a huge economical implication as to why it would be going down. But typically it's one that goes up. Classic cars, wine, gold, all these types of things are things that would be, financially speaking, normally will appreciate. So that's where you should put your money. And borrowing doesn't always necessarily have to be a bad thing. So if you had £20,000 cash in a bank account that was earning you some interest, and a finance lender offered you £20,000 finance at 0% on a car, normally speaking, you should take the money or the finance because it's free money, because it's 0%. Buy the car on finance, keep your money invested and earn a percentage interest on it. I did that with my student loan. So my student loan came through and I invested the money. and I got a percentage back on my student loan, and then I just paid the student loan off and just kept the difference because I was living at home, so I didn't need to pay for halls or anything. So you can make finance work for you in the correct environment. Which is good and which is bad. So these are questions which are more for an open forum, and we kind of have a discussion about it. But there's some there, covering them off. Is a house a good or bad investment choice? I think most people would agree that it is. Typically, they're going to go up in value. You're putting your money into something. The older generation would always say you can't go wrong with bricks and mortar, and a lot of people stick by that notion, to be fair. Stock market, is it good or bad? You can earn a lot of money in the stock market if you know what you're doing, but a lot of it is second guessing, and you've really got to have the time to make it work. You've got to have the time to really just to sit there and go through the stock market and look at market influences, what's going on, what's going to change it. So, I mean, really, unless it is a professional thing, it's not really the greatest investment choice. New business. You might get people who invest in new businesses like Dragon's Den. I'm sure most of you have seen Dragon's Den. They invest in new businesses. It can be a risk, but it can be a good one. It depends on what the business is, what it looks like. Is it new? Are they doing something different? And, is it worth investing in it? A car as an investment choice, pretty much I think we can all agree that's a bad one. Most cars lose money the second you drive them off the forecourt. So as an investment, it's not a great one. I suppose like a classic car, like a classic Ferrari might be a good investment choice, but investing in your brother's Corsa probably isn't the best option, to be fair. Second home. I know it's a bit of a bone of contention in Cornwall, but if we ignore the opinions about people with second homes, as an investment choice, it's quite a good option. If you had money and you wanted to invest, you wanted to make the money work for you, investing in a second home to rent out on the rental market is quite good. Cornwall is about a 6 to 7% yield, which means for £100,000 investment, you'd get £6,000 to £7,000 back per year in your rental income, and your 100,000 is protected in the property. So as an investment choice, it's quite good. And pensions, we'll look at kind of pensions a little bit later, as to why you guys, if you haven't, should start getting one or thinking about having one, or just thinking about saving for the future. So if we come on to this, hopefully you guys can all see that. That's a table which I've kind of done to give some examples of how people can save over a period of time.
Sorry, James, we can't see the table for some reason.
You can't? Okay. Can you see that one?
No, you're on your budget. It's on budgeting.
Okay, so why is that then? Oh, I have to do a new share. How do I do that then?
And if you go,
we'll come back to that. It's okay. We'll come back to that at the end. I'll try and figure out how to do that. I think I have to end the PowerPoint and then do that as a new one. I can't do both.
Yeah.
So we'll come back to that. So apologies for that.
It's okay.
So budgeting is where people make their money last as well as they can. The photos on the screen definitely illustrate myself. Payday, you feel like an absolute billionaire, and then for the rest of the month I'm on bread and water. But it's important as to how you can make it work. A lot of you may be going to university at some point, going into work, you may be in work already, and it's how you can make your money work. And especially in the environment that we're in now, people are feeling maybe the budget doesn't go as far. Maybe they're on an 80% income rather than 100, and they're trying to have to make it last. And it's just important as to how you can budget. There's some budgeting apps which I'll give out later, which are really handy. You can kind of input your monthly spend, and it breaks it all down, and then you get alerts telling you to stop spending money on shoes or clothes or whatever it is that you buy. So they're really quite good. But on the whole, when I sit down with clients, it's just adding up everything you have coming in, which gives you a figure X, Now, this could be anything. It could be work, it could be benefits, it could be pension, it could be maintenance, it could be any form of income you receive. We put there as a total. And then your essential spending is the things that you have to spend if you didn't leave the home. So things that you've got to pay, car finance, mortgage, electricity, water, phone contracts, those types of things. They're essential spending. That's what you've got to pay out for. And then the bit that you've got left over is your disposable income. And that's where we break it down. I mean, I break it down into weekly amounts. So I know that I've got, 50 quid, 100 quid, whatever per week to spend, and it won't impact my living with paying my essential bills. So it's all about prioritizing. When you go to university, you're going to be on a limited income, and you really have to make that last. And believe me, living like a rock star for 2 months and then not being able to do anything for the rest of the year makes it really dull. So budgeting and making that money last will just make your experience that much better. So it is really important to get into these practices of making it last, and making your money divide well over the month. So yeah, this is when we need to excel. So we'll kind of come back at this. That's just all about saving for the future. Gambling is something that a lot of schools that I've been going to have asked me to put in this, because it's now becoming a serious problem. I've got some examples I can give you guys that will shock you, to be fair. But gambling itself is the wagering of something of value, money, watches, cars, whatever people gamble away on an event with an uncertain outcome. Boxing, horse racing, poker, whatever. A lot of people will do like the odd little bit, like they'll put a bet on the horses at Christmas, that type of thing. So you may not know you've done it, but that is gambling in essence, because you don't know the outcome. But it can be a serious problem for those who get in debt, because you get this buzz of winning and you need to try and maintain that buzz and keep doing things. So when you just keep getting stuck and then you lose, and then you need to build it back and need to get it back, and that's a huge problem. One of my clients, a very rich client, goes to Vegas every year, and he takes a huge amount of money and just gambles it away. It's money he can lose, it's disposable income, if you will, and he would just gamble that away. And the biggest loss he ever had was 4.2 million in one weekend. So he went to Vegas, was up, kept winning. Stakes keep getting higher, because the more you win, the more you bet, the more you keep going. And he lost, about 4.27 million over the weekend. And I remember speaking to him and saying, did you never want to get back in and see if you can win it back? And he said, but at some point you've just got to turn the tap off and stop. And he started with 500k, and he just kept going up and up and up and up and up. And then he got to, 5 mil, and then just lost it all in one event. And that's how serious gambling can be. And he had the money to throw away, but believe me, it was a big hit to him. 4 million to me is, I can't comprehend it. But to him, it wasn't a huge amount of money, but it was still enough for him to go, I'm going to stop this. And it's knowing when to get out, which is the thing that some people don't really realise. I was shocked by this fact. There's 55,000, it's probably higher now, 11 to 16-year-olds in the UK that are problem gamblers. And that's, when I say problem gamblers, I don't mean they've not got the money to do it. I mean, they are addicted to gambling. They're borrowing money, they're stealing money from parents they don't know about. And the way that they hook young people today is through games, online games, or games on your phone or your laptop or Xbox or whatever, where you buy items, I assume, to play the game, and then you keep playing it and you keep buying it and you lose them. And that's how they kind of get you into gambling, because you're paying for something and losing it and then paying for it again, like a gun in Call of Duty or something like that, and that's how they get the hook in there. And a lot of these companies will give you free things to encourage you to gamble more. So they'll say, if you invest £200 on this online poker site, we'll give you a ticket to a football game at a discount. So they're actively encouraging you to lose money. They're preying on people who have that addiction. So it's just be mindful of the triggers, and the best thing to do about it is if you are spending money on a gaming event, then just tell someone, because if there's nothing wrong, then there's no harm in sharing it. But I've seen people have to remortgage homes to pay off gambling debts, had to sell items, lose family members, just because their partners haven't been able to keep up with it, and it does become a huge problem. So it's just something that people really need to be aware of. The next few slides are something that I've thrown in for kind of college students, and it's looking at how things kind of went wrong in the financial market back in 2008, what happened in the American housing market, things like that. So I've thrown it in there. I don't know if you want to cover it off and have a look at it, if it's relevant to some people, but CDOs was the main problem that happened. And what it was, it's when these finance houses, they take money and they will just lend it out to people, and they didn't really look to who was repaying it, because they would hide it in other areas. So for instance, let's say there was 10 of us that was borrowing money, one person wouldn't pay that money back. They didn't care, because they had 9 people who were paying it back. So they would hide the person who wasn't in this CDO, and then they would sell that CDO to another company, and that company would reclaim the debt. But that company had no idea who the one person that wasn't paying it was. And then they would then sell it again and add to it. So the one person got diluted down so many times, they just had no idea who it was. And originally it wasn't an issue, but they soon started realizing that people weren't paying, these loans defaulted, they didn't know who it was, and it just went up and up and up and up and up the layers. And it just got scary. I mean, there's a figure there from 2004 through to 2007, $1.4 trillion worth of CDOs were issued, which is just a huge amount of money that was just in there. There's more information in there that we can read, and as I said, if anyone wants us to go back over it at the end, pop a question in it and we can go back on it. This image, it's a little bit busy, but it just explains what I've said there. So as you can see at the top, all the black houses are ones that are being repaid, and the red ones were defaults. And then what you'd have is all the payments were coming down and trickling through into these tranches, and the AAA ratings were the high ratings that were all being paid. The ones down low are the ones that weren't being paid, and then in the middle the ones that were. And then you've got across here all these different tranches that were flickering through, and you can see at the very end there where they've got the most defaults, only the AAAs were being serviced. The AAA, BBB and BB underrated weren't being serviced. But then when they collectively put them all together into a CDO, the CDO was all being paid, because the money from the other tranches were paying off the debts of the ones who weren't paying. So everyone was paying for each other's debt. And that's when it all became bad. And this bottom left corner could be done up to 4, 5, 6 times to create a CDO squared. So when you're looking at it, no one had any idea who wasn't paying, because you could not trace the money. So when you had huge numbers of people not paying mortgages, that's why it all collapsed, because no one knew who it was and who they could trace, and that pretty much fell to the collapse of it and the demise. As I said, that I can send out. It is interesting. The Big Short on Netflix, I'm sure some of you have seen, that covers it pretty well. It's quite an easy to grasp, but this just kind of touches on why, because it was such a big issue in the financial industry. This is a little bit about trading, so stock market trading and how people trade on the markets. So CFDs is quite a common one, but what you're doing is trading the negatives of a stock market. So you're betting on the stock market going down. So you're making money on a rise. So you're basically buying high, betting that it's going to go low, and then you sell out. It's a reverse negative of the stock market. Similar to spread betting, but it's not exempt from capital gains tax, and it's just an agreement between the two. The reason why you can make good money or big money on CFDs is it's leveraged. And what that means is if you put £1 in, you might be able to buy £500 worth of a CFD stock, which means your gains are huge, but your losses are equally huge. And that's why CFDs is a really risky one to go into. And again, you've really got to have the time to do it. This is getting a little bit heavy now. Dark pools of liquidity, they're all just, they're words that people may see in the stock market, basically. It's a private form of trading securities. They're looking at things that are hidden. So they're hidden from the NASDAQ or the New York Exchange. So people don't know what's going on. And they can affect market prices, but you don't see them, which is why sometimes stock markets change and the price changes, but no one can see why, because these dark pools of trading are happening, but they don't have to disclose them. It's basically just shadow trading. Derivatives, some people may have heard the term derivatives. Financial security or value that's relying upon underlying asset, commodities, rice, gold, oil, sugar, currencies, forex, all these different things. They're contracts between two people to buy and sell at a different price. So we've kind of blasted through it. I'll call it an open session, but if I stop sharing, then you can see my face. And then if I share this one, can you see it now? Cool. So this was the savings table that I just wanted to cover off with you guys about saving for the future, and how getting an early start on your savings can make a massive difference to the amount that you'll have in a later life. So I don't know if you're aware, but the current pension income is around about 8,200. It might have gone up, but it's about £8,000 a year, which is nothing. I mean, it's a really low amount per year or per month to have. So a lot of people have private pensions or private savings accounts that they pay into. Companies will set up a pension for you and you can pay into it and they will match it. That's a really good option for you. If your company allows that, you should definitely take advantage of it because it's tax-free savings. But over here on the left in the yellow, I've just put some monthly figures as to what you could start by saving. 1550, 100. I mean, obviously £1,000 pretty, not realistic for people, but just to illustrate the numbers you could get. And then the columns going down are what you'd have in a year, 10, 20, 40, 60 years, because it depends on how old you are and when you start. And I've thrown some interest in there. I think I've done like 5% compound interest. If you don't know what compound interest is, basically if you started with £10 and the interest was £5, you'd then have the £15 put up 5% of £5. You'd have that higher figure at the end of the year. And then the next year you'd have 5% of that higher value. So it wouldn't go up by 5% every year. It would be like 5.1, 5.12, 5.4, and it goes up like that, which is why the figures aren't multiples of the column on the left. But for instance, if you save £15 a month from a young age, in 10 years you'd have £2,000, okay, which isn't huge, but then you could start saving more into it. I mean, £1,000 a month over a 40-year total is $500,000. Now, that may seem out of reach, but with two people or a couple in a household paying in a good portion, you could get near that amount over a certain amount of years if you were managing and saving frugally. But below, I've done an example of someone's life cycle and what it might look like if they were saving. So for instance, from the age of 15 or 20, you might save £15 a month for 5 years, which is £1,000. It's not a huge figure, but then you're not saving a huge amount, okay? But then for the next 10 years, you might up it to 100 quid, and then you've got 13 grand. which it starts building up. Now, don't forget, this is your like retirement fund. It's not, you know, a savings for holidays or anything. And then you might up it to £300 a month because you might have a pay increase again at work, and do that for a few years. You're up at 80,000. Then you up it to 500 because maybe there's 2 of you in the household, and then you get to the 132. And you add these together, and after 55 years, when you could be retiring or thinking about retiring, or already retired, hopefully if it's me, you know, £250,000, which added to your state pension of £8,000 a year, will give you a good lifestyle to live on. And I know it seems like it's such a long time, but imagine you wanted £250,000 in the example, and you've saved 15 and 100 and 300. If you look at the table, let's say we started later in life and we only wanted to save for 20 years. Okay, you would need to save £1,000 a month for 20 years to get the same figure. So that's what I'm trying to illustrate about the importance of starting early, because the earlier you start, the less you have to save. You don't have to claw it back towards the end. I speak to clients who are 40, 50, who don't have a pension. They don't have a savings pot, and they've got £8,000 to live on per year for the next retirement. And it's not going to be the lifestyle they want. Also, you need to remember that pensions don't normally go up, but the cost of living does. So that £8,000 will be able to buy you less and less and less. Think of it as like the price of milk. It used to be 50p a litre, now it's £1 a litre, something like that. So your £8,000 used to be able to buy you X amount, and now it can buy you Y, it can buy you a lot less. So it's really important to think about saving for the future and taking advantage of company pensions if you've got the option to have one. So it's been a little bit kind of back and forward, but if we go to the questions, if I pass it back to Jen, and then if she's got any questions that have come in, it might be a bit easier just to kind of have a bit of an open session, really.
Oh, thank you, James. That was really interesting. I've had one question in so far, so if anyone else has got any other questions as well, give us a shout. From Becky. Becky has asked if you had any advice on where to find recommendations somewhere to get that 5% interest, if there was a sort of savings account or whatever.
Yeah, I mean, most banks now will give you a better savings rate if you can put it away for a bit of time. Doesn't necessarily have to be a long time, but bonds and things like that. So a lot of banks will issue just normal investment bonds or savings bonds or premium bonds you might have heard of, and they'll give you a better savings rate. I mean, I did 5% just because it was a sort of like an average. I mean, obviously interest rates have dropped substantially since doing that. They're, you know, 0.1 at the minute. So 5% in a quick access or instant access account probably isn't that achievable, really. However, if you're looking at the example of saving for a long period of time, then yeah, you probably could get somewhere near that. Private pensions companies, there's Royal London. I think they start with a minimum of £50 a month, but it depends on how old the person is. But yeah, £50 a month is their minimum to start a private pension. And they will invest it in like an index link. So they'll put it into like a stock market linked portfolio for you. And you could achieve 5, 6, 7% based on what the market's doing in that. But short term, if you wanted to save for a year to save for a holiday, no, 5% is probably not achievable in that sense.
Cool, thank you. I think I just had another question in. Okay, so from Felicity, would you recommend high risk long-term stocks and shares at this time to boost your pension pot?
So it depends on the age of the person who's doing it. So with high risk is high return, but obviously if you lose, you need to be able to claw that back. So if I said to you, let's say you've got the pension pot that you're saving for over a certain amount of years, would you rather lose 20% in the first year, or would you rather lose 20% in the final year? Now, the answer is you'd rather lose 20% in the first year because A, your pot is less, so you're financially losing less, but B, you've got so many years to make that saving back up. If you lost it at the end, A, it's going to be a bigger amount, and B, you've got no time to make it back. You know, you'd have to save £2,000 a month, for instance, to get that saving back before you start drawing upon it. So is high risk worth it? If you're younger, yes, most portfolios will be high risk when you're younger, and then they'll flip. So they'll go low risk as you get to a certain point in time and you get older. The risk attitude will change to secure and protect your investment. In this market, the markets are just all over the place at the minute. You know, the euro's going up against the dollar 1 minute, it's going down against the dollar the next minute. Our FTSE's up today, but everything else is down. It's just all over the place. So really, at the minute, until we kind of hit this equilibrium and balance out, I'd probably keep it at like a medium risk, regardless of age. And then, as I said, once it levels out, if you're of a younger age, then yeah, you could probably increase the risk a little bit. It depends if you manage it yourself, though. Someone may manage it for you. I don't know.
Cool, thank you. Hopefully, Becky, hopefully that answered your question, Becky, about ISAs. But if not, let me know. So a question from Jenny: how do you think the current COVID-19 will affect the housing market?
So I've had a few of these discussions recently with clients who are looking to buy, or they're in the process, and the government has said, hold off, don't move, you know, put it all on hold. For one reason or another, it might be, you know, just because the health implications, people don't want you moving home or whatever. But at the minute, if it was me and it was my money and someone said, put a bet on, what do you reckon they'll do? I reckon personally they're going to go up. The reason I reckon it's going to go up is because of the whole supply and demand thing. I mean, I've got a huge backbook of clients at the minute who are ready to go. They're ready to push the button and buy a property. Interest rates are so low that we've secured the rate for them on their new mortgage based on the low. And then when the second they can buy, they're going to pull the trigger and start buying. So if you've got this huge influx of buyers in the market, and you've got a bunch of sellers who are going, hang on, everyone's now buying because they've been on hold for 2, 3, 4 months. I think the price could, or the demand could go up, and therefore the price could go up. You know, if you're a seller and you've got X amount of people viewing your house every day, you'd probably put the price up, or you wouldn't take a hit on it. So personally, I think it's going to go up. They always try and do a bit of scaremongering. I remember when the whole Brexit thing was going on, there was a 12% figure that was thrown around. House prices were going to fall by 12%, but they didn't. It's almost like they say it and people think it's going to happen, so it almost does, but then it doesn't, because I think in that sense, the British are quite resilient, and they just kind of go, do you know what, we're just going to do it anyway. And therefore, that's why I think it would go up.
Resilient or pig-headed?
One of the two.
Either I like it.
Yeah, one of the two.
Thank you. Okay, so another question. We've got a few coming in now, which is good. So what age would you class as older, and when to maybe reconsider?
Oh, God.
Is that referring to the sort of risk you take?
I assume, yeah, I think that's what they mean.
Yeah.
Okay, so being careful with how I phrase it. In terms of...
Sorry, I was just going to say, you've got to be politically correct.
Exactly, yeah. It's a difficult point to address.
Yeah, that wasn't me, but I'm in that older category. I'm not a student.
It's fine. In terms of the risk element, going on clients that I've seen who have a pension that's invested in a risk asset, or it's under a managed portfolio, is normally kind of around the 50 age range that the risk starts to try to dip down. If you were on a perfect life cycle of investing in a pension and you started at 25, it would kind of be like 25 to maybe 45 would be high risk or a higher risk, because you've got the time and probably the income to get back any losses that you make. And then kind of 45 to 50 or 55 would be sort of like that medium, and then they kind of flip it round dependent on when you wanted to draw. If you wanted to draw your pension at 55, then the life cycle may look a little bit different. Or you may stay medium risk until 55, take your tax-free lump sum, and then turn the risk onto low and keep it invested, but in a drawdown access, like the old investment packages where you could still draw out and it was a guaranteed income, that type of thing. But yeah, 50, 55, I would say, is when they start trying to reduce the risk down.
Cool, thank you. We do have some more questions. So, hi James, looking forward to, I would imagine house prices will fall.
Yeah.
I think it's a bit different with loss of income and employment unfolding. Is negative equity going to put many in serious financial difficulty?
Okay. Yeah, I mean, it's a good point around the income falling. I mean, it depends on to which way you want to look at it. I mean, if you said, there's a lot of people that are going to lose their jobs and they're going to lose their income, then in a normal environment, I would probably agree, because there's going to be a few houses going up, there's going to be a few bankruptcies or repossessions and things. I think given the fact that it's something that has hit the world and everyone is aware of it, and it's not one person's fault. It's not like someone's gone into work, punched their boss, lost their job, and then they're going to lose their house. Everyone has been affected by this in some way or another. So I think a lot of financial institutions are going to be a bit more lenient. And believe me, mortgage or lenders don't like repossessing houses. It is a hassle for them. They've got to take it, sell it, try and get the debt back. So they don't like doing it. So in that sense, I'm not entirely sure that it's going to affect the market like it did back in 2008 with the houses coming on through repossessions. In answer to the question about the equity, it's hard because we went through this period of doing 95% mortgages, so the equity is only a 5% buffer. So they would have to drop by only a small amount to then start hitting that negative equity. But if house prices aren't affected, then no, they're not going to hit that negative equity. If they do start going down and then we do hit that negative equity, you're only in negative equity if you sell. So that's an important point to remember, that although on paper you're in negative equity, unless you sell, you're not. If you keep the property and the property prices rise back up, you haven't lost. It's the same as the stock market. If you invest money in the stock market and it drops, you only lose if you sell out at that loss. If you keep it and it goes back up, then you're fine. It's the same with houses. If you go into negative, but the market recovers and the house price goes back up, then you're okay. And most people aren't going to sell at a negative loss on a property, to be honest. Does that answer the question?
I believe so. Just said thank you.
Okay.
Cool. Fab. Is there a website to see what services that you offer, James?
Well, so my website is currently being redone because I'm adding a bunch of videos to it and blogs and stuff like that. But my Facebook page, I use primarily. That's all the information on there, and that's just cheap mortgage quotes on Facebook. I always put information on there about what we do and what we offer. But feel free to message me or message the page if it's something not related to my business. I'm more than happy to help people, with questions and things. And as Jen said at the start, I've been encouraged by others, because I normally wouldn't do it, but I've been encouraged by others to make a YouTube channel. So I'm going to be doing more of these like small snippet videos and putting it on there. God knows how it'll be and how it'll look, but I'm going to give it a go and just try and get it on there, and I'll do links to that. But yeah, for the time being, it would be on my Facebook page, Cheap Mortgage Quotes.
Cool, thank you. Another question. Is your office based on the main road in Perranwell near the Norway Inn?
No, no, I know what you mean. No, same name. No, so I used to have an office in Newquay, but I never used it, being honest. People don't really like coming into an office environment. I find it's a bit too formal. And a lot of the time, you know, people in work 9 to 5. So I would be sat in the office 9 to 5. You're sat at work 9 to 5, and then you want to meet up afterwards, and I've still got to work. So there was no point having it. So I just got rid of it, and now I just do virtual meetings, or I go to client homes. We'll go to Costa, we'll go to a pub and have a beer. You know, it's just keeping that more informal environment now, which I think a lot of financial advisors have kind of stuck on the older way of working, whereas we tend to be a bit more informal and a bit more chilled and relaxed, really.
That's cool. I just have a quick question, actually. So with mortgages now,
Yeah.
and any sort of thinking back to what happened with the housing market crash.
Yeah.
Saying because, see, I'll be honest, I find sort of finance stuff really quite confusing. So is it because so you said it was 95%, wasn't it? The sort of.
Yeah, I mean, that's the minimum now is a 5% deposit.
Yeah, so because of that, it's more stable and it's not likely to happen again, because is it not built on the same tiny loans or whatever?
So back in 2008, there was, it was more kind of free and relaxed in terms of legislation. So, you know, there is an example back on the slide of, I think it was a Mexican road sweeper with an income of $15,000 a year, got a mortgage for like £700,000, which you would need literally an income of 200 grand a year for that. So they didn't care back then. They would just put anyone through. Depending on your age, you may have remembered self-cert mortgages. That's when someone who's self-employed, they just say, yeah, I earn 50 grand a year. The mortgage company went, yeah, sounds great. Here's your money. Off you go. And then they didn't earn that amount. So that's why the problem with the housing market back then happened, because everyone just went, well, I can't pay this anymore. And then off we go. Nowadays, it's much more strict. The paperwork we have to supply and prove evidence of is crazy. I mean, my clients take probably about 35 hours of my time, dependent on the complexity, whereas previously you could have done it in 5 hours. So now I think it is a lot more secure because people are properly assessed, and that's why we see a lot of the argument about, I can afford rent at the moment, why can't I get a mortgage? I pay £700 a month rent, I can afford a £700 a month mortgage. You can, and I agree to a point that rent should come into it. I think someone should be able to supply evidence of paying rent for a period of time, and that be used in the assessment of the mortgage. However, if your rent went up, so if your landlord's mortgage went up and they decided to put your rent up, you could just go, do you know what, I'm not going to pay it anymore, I'm going to go move somewhere else. Okay. If you're tied into a mortgage for 35 years and the interest rates go up and your payment goes up, you can't just go, I'm not going to pay it, I'm going to move out and go somewhere cheaper. So that's why they have to assess you based on an income rate or an interest rate of 6 or 7%. So if it did go up, you could pay that. So that's why, although yes, you can afford £700 a month now, could you afford £1,000 a month if interest rates went up? And that's why a lot of people, the difference isn't quite marrying up for people. So that again illustrates that it's much more strict now on lending. So I think a crash is going to be a lot harder to happen, or a lot more difficult to happen now in the market.
Cool, thank you. I think that's something, as someone who rented for years, especially in Newquay, I did find it a bit confusing, because actually you normally end up finding that you pay higher rent than you do, because obviously people make a profit on what they're renting to you.
Yeah.
Otherwise, I suppose why would they do it? And then when I've managed to get a mortgage, and actually I'm paying so much less than I would have been rent-wise.
Yeah, you are. I mean, mortgages are normally cheaper than the rent aspect, because as you said, there's a profit built in. whereas on the mortgage it's just primarily for that. But also we're looking at mortgages at the minute when rates are so low. You know, there used to be a time, not in the prehistoric future, but when there were 12, 13, 14% interest rates on mortgages, which would be catastrophic to people on an income of a 1% mortgage, 14 times interest. So that's why they assess it a lot differently. But I do think it should be taken into account because you're effectively showing that you can make a payment on time. So I do think it should have more of an impact on if you can get a mortgage, and it should be considered. But I don't think it should be, I pay rent of 700, I can have a mortgage of 700. I think there needs to be a good balance between the two working together.
Cool. I kind of have one more question as well. I don't think there's any more questions come in yet. And then we can leave you in peace. Something else that I do understand, but it also confuses me a little bit. Why is it that you have to be in debt to get a credit rating? Why is it that you've never been in debt at all?
Yeah, so your credit file is obviously something that lenders will look at as to whether they should give you money. I personally think there should be one company, but there's like 7, and they all look at different things. So you may go to Nationwide and they will look at Equifax and TransUnion. You may go to Halifax and they look at Credit Karma and someone else. So they have different information, which again doesn't make sense to me either, because you're still you and it's still your credit profile. But the reason why is because if I came to you and said, I'm a Michelin star chef, but I'm not going to cook anything for you, you would have no idea if I was a good cook or a bad cook. And it's the same with your credit file. If you go to a credit lender and say, hey, can I borrow some money, please? I will pay it back. I'm a good credit risk. And they go, well, hang on, you've never had anything before, so we don't know. We've got nothing to go on. So that's why having a bit of debt and paying it back shows that you can borrow and repay. So all of the young adults I speak to, I always say, just get a credit card. Get the credit card that's offered by your bank. Just do like a £500 limit on it. Buy a Starbucks or a Costa once a week and pay it back. Fill up your car and pay it back. You don't get charged interest, but you're borrowing and paying it back, so it shows that you're a good credit risk. And that's what they look at. The amount of people that I see that are 21, 22, 23 and have got no debt because someone told them, their mum or their dad told them, rightly or wrongly, that don't get debt because then you won't affect your credit profile. But actually, I can't help them because they've never had debt. So I can't show that they're a good or bad risk. Equally, it's just popped into my head, payday loans. So payday loans are out there. They're really popular. It's an easy way to get money. They're thrown at you. There's no checking. Have it in your account the next day, whatever, and all this nonsense. If you want to buy a house, never touch a payday loan. Even if you borrow it and pay it back on time, a mortgage company will more than likely not give you a mortgage. Because the point of a payday loan is you don't have the money and you need money. So if you go to a lender then and say, can I buy a house, please? They're going to go, well, 2 months ago, you didn't have enough money to pay your bills. Why are we going to lend you £1,000 a month to buy a house? Whether that's the truth or not, that's how it looks to them. So never touch a payday loan. Borrow it from your friends, your mum, dad, anyone. Do not touch a payday loan.
I think also those payday loans, when you look at the small print on the adverts, their interest rates are like 100-something% half the time.
Yeah, some of them are like 1,000% over the year.
It's awful.
Yeah,
and it's terrifying crazy. Because it shows how like people are taking advantage of people who are struggling by putting more and more of these payday loans. It's really horrible.
And they're doing, credit card companies will boost your credit risk and everything. The most debt I've ever seen from someone that wasn't a mortgage debt was £342,000. and that was debt that wasn't mortgage. That was credit cards, loans, car finance. Yeah, crazy amount.
Wow.
Yeah.
Just had another couple of questions in, asking the sort of same thing. How can you check your credit rating, and does it affect your credit rating every time you check it, or is there some way you can go and check it without it affecting it?
Okay. Yeah, checking your credit file doesn't affect it. And you can check it. There's a bunch of companies online that do like a 30-day sign up for free, and then it's £15 a month. There's Equifax, Experian, TransUnion, but the one I would recommend is called Credit Karma. Credit Karma is free for life. You never pay for it, never pay to do anything with it. It's not the most comprehensive, but it is enough. Mortgage companies use it to look at, so it is detailed enough, but it's free for life, free to sign up for. You've got to put your bank details in because obviously it has to find you. But yeah, and that will give you a rundown of your credit, and it tells you like pros and cons. So it says what you could do to build it up, what you could do to reduce your credit file. But yeah, that's the one I would look at. Credit Karma is online. Fab.
Thanks, James. I just had a few messages come through just saying thank you, and someone has had to nip off. I know he's got a baby as well, so that's probably why he's had to.
That's right. Yes, right.
So yeah, unless anyone's got any more questions, but I think we're all good. Yep, fab. All right, well, thank you so much, Jay. Oh, it's come up again. Thank you so much. Another person's message.
That's all right. No. Thank you for having me. And as I said, I hope it's been informative. I'm used to a more interactive environment, so I can kind of judge what people are thinking, and they can throw questions in. It's hard sometimes just to chat for 40 minutes and know that everyone's still awake. But it's hopefully some people have taken some stuff away. As I said, if anyone wants any more information or wants to ask a question about something a bit more detailed, you just go onto my social media page and just message the page. I'm more than happy to help people out.
That's amazing. Thanks so much, James. And
no worries.
Thanks everyone for joining us. And we've got more stuff coming up throughout the rest of the month, so stay tuned. Cheers.
Thanks everyone. Take care. Bye.